Good afternoon, everyone, and welcome to the Sydney Market Outlook 2016.
And if you look at the key drivers of growth we're expecting for 2016, very similar to last year. So we're likely to end up somewhere around 2.5% GDP growth, which is okay, but it's a bit below trend. The main points that are of interest to commercial property markets, though, are what's happening in the sectors that occupy space. The better news is that the service sectors are growing more strongly, on average at closer to 3%. And the IMT industry is growing a lot faster than that. So service economy is doing better at the moment. The other key point for Sydney and for Melbourne is that the southeast of Australia, the economies there are a lot stronger. So it is supporting demand, it's supporting jobs growth, and it's supporting commercial property markets in those regions. A lot of talk about downside at the moment in the market with the global uncertainty. Our view is that if the downside scenario does play out, it's going to become pretty evident in the next 3 to 6 months. But on the base case of 2.5% growth, we'd say that things like interest rates stay on hold for most of the year.
So Josh, I think we'll kick off with you and talk about these capital flows that have been with us for quite some time, which don't seem to be abating in any way.
On the capital flows, I mean, look, we live and breathe it where we sit and what we do with our markets through Asia. Certainly no implications for any capital flows slacking off this year. Already, late last year, you've seen more Korean groups coming down spending money. I mean, they spent $950 million in 6 months late last year. We're very attractive, and I think it wasn't pointed out enough in that report of that investor survey. It's the first time Australia and Sydney's been ranked #1 as a destination for overseas capital coming down.
Over to you now, Jenine. We saw a lot of arrows pointing up in a number of sectors through the presentation previously, which does support Sydney's growth in regard to rental. What are your observations at the moment?
From a transactional perspective, we're certainly seeing that we're end of the downward cycle. But look, I take you to a bit of context there. 2015, we saw almost identical amounts of demand as the previous year, but our transactions were up 40%, and we were most active in the top end of stock, and we were most active in the projects that we're working on. We saw some really strong rental growth, 13% in the B grade market, and that's going to play out again this year.
Okay, so what actually happens to the rent this year? The effective rent, what happens to your incentives this year?
I think we'll continue to see forecast net effective rental growth. And in the B grade, we're trading now at incentives of 5 to 7% of where we were last year.
How are we looking compared to last year here in Sydney?
What we're experiencing is I think, a much more of a return to a normal market. We've had 2.5 years, nearly 3 years of an incredible market, a period where we've been selling our projects 100% at launch, often, and probably averaging about a 70% clearance rate within sort of a week of starting sales. Our inquiry's been growing sort of year on year at about 25-30% from buyers. We've had a sales take-up of buyers coming through the sales office has been as high as 1 in 3 people visiting a sales office have been buying. So we've come off a really extreme high to now what's not an extreme low. We're sort of achieving sales rates that are more reminiscent of 2012, 2013.
We'll move on to you, Jason Edge, and focus on the industrial sector. Henry and Stephen talked about there being some modest growth in the rental market. But what are your observations of the leasing market presently?
Certainly pockets in Sydney where we are definitely seeing that. And I think South Sydney's a really good example of that. It's just the lack of land. So that's everything from Western Sydney down to southwestern Sydney. We're seeing development across the board.
Does Sydney run a risk in that regard where other states with a bit more land might become attractive or an alternative proposition?
I think if you're a 3PL provider, and probably an occupier, you've got to be based in Sydney. I think other groups have looked at regional or national DCs elsewhere, but if you look at the hub and spoke model, which a lot of these groups are now looking at, they've got to be dedicated in Sydney.
I really wanted to talk about three things, and that is that Australians are really hungry. We're driven by our appetites, and we're spending a lot of time doing things that are around food, in and around food. We're socialising around food, we're talking around food, and we're basically creating our new shopping centre environments that are based around food. In the past, it'd be fair to say that we would have topped out at about 25 to 30% when we were looking at what food made up in a typical shopping precinct. We've now got examples such as Central Park, which has got 65% food and beverage, and it's a real change to how we're seeing this market.
It's been a really healthy market for us in asset services. We've had strong jobs growth in New South Wales. Consumer confidence is up 4.2% in February. And I think that's translated into some really significant shifts in demands from our clients and their customers. And I say the word customer specifically because this is the language that our clients are using. So the era of the tenant is absolutely dead. That feudal relationship of landlord and tenant is being flipped on its head, because the landlords no longer have the luxury of demanding how a building is run. The customer or the tenant is being very clear and specific around what they want. And it's that long-term planning around where they want to be located and what kind of corporate culture they want to represent through that built form. We're getting more and more demands for either official well-rated buildings or well programs that we run through the asset services program. So those well programs might involve mental and physical health programs, but also in the design and layout of the office to ensure that there's more daylighting, circadian lighting. So I think that this industry has been involved in a race to the bottom around price, and it's time for that to stop, that we focus on service and quality and better differentiate ourselves in the market.